हाय गाइस, गुड इवनिंग टू ऑल ऑफ यू। स्टॉक मार्केट्स की पाठशाला में आप सबका स्वागत है। वेलकम टू ऑल ऑफ यू। Today we have gathered here as we are entering into a new year. First of all, happy new year to everybody, to all who are listening. As we have gathered here to discuss about what will happen in the stock market in 2023, what is our outlook? Uh, Firstly, a macro view, what is going to happen in the world, what is going to happen in India, and then we will break it down sector by sector on how you should be investing as of now. As Let's start with a macro view of the world. So what we are seeing is a big slowdown in across the world, in Europe, where the natural gas prices have really hit the economies really badly. Now the natural gas prices are coming down as the demand continues to cool off, but nothing can be taken for guaranteed until Russia's war in Ukraine comes to an end, uh, which we are not very sure about. So one thing is very clear: Europe is undergoing a big recession. Big European countries such as Germany or Britain are undergoing a big recession. That's something which is very very clear. Uh, then let's come to the second point. The second point is we are seeing US also because the interest rates have gone up from about 0 to about 4%. Uh, the US is also undergoing a big recession in 2023. It will undergo a big recession. How long will the recession last will depend on how how much rate hikes are left from the US Fed and how fast the US Fed tries to bring down the interest rates. So it will generally depend on how the US Fed is uh, able to able to uh, manage the economy and how fast interest rates do really come down. That's the second point that is there. That uh, US is also undergoing a big recession. How fast the US will come out of the recession will continue will is a point to be seen. However, 2023 will be very very difficult for the US as well because there's a recession coming up, and we've already seen as a consequence of that 50% of Nasdaq has corrected by 50%. So that's the second point. Third point is the Chinese economy is undergoing severe pain. COVID is coming back in the Chinese economy. Uh, we don't exactly know how what is the exact situation in China. How many people are affected with COVID? We are hearing 1,000 or 2,000 deaths every day, so we can't really understand what's going on there. So, considering that China is also undergoing slowdown, housing market in China is slowing down, and there are on and off lockdowns in China as well. So China also has its own sets of problems where the Chinese economy is undergoing slowdown, and the where the world is all central banks across the world are tightening. The Chinese regulator is cutting down on interest rates so that it can stimulate growth. So there's another problem that China is also slowing down. So, on the macro view, Europe is slowing down, US is slowing down, China is also slowing down. So, what is left? The only economy which is going to grow at about 5 to 6% is India. That's one thing that is very clear. In my previous space, also, I had said that the Indian economy is the only economy that is going to grow by 5 to 6%. So that's not really a problem. That's why investors are flocking into the Indian economy. Uh, Investors are wanting to invest in India. We have seen uh, huge inflows from the FII, from the DII, investors into the Indian stock markets, and slowly and steadily FIIs will also start to come in as they find that India is the only economy where they can invest. So uh, the Indian market continues to be extremely strong. We have seen about just 10% correction in the whole of 2022, whereas all other markets have been severely correcting. So in my view, not a problem as such. The Indian economy is continuing to be very very strong. In 2023 also the economy will continue to be very strong, and that's seen by some leading indicators that continue to be very strong. That's the second point that is there. The third point that is there, even though the Indian economy will continue to remain strong, the valuations continue to remain extremely lofty across all sectors. Most sectors are very, very expensive. The Indian market as a whole is also very, very expensive. So while on the overview, we may say that the uh, growth story of India continues to be extremely strong. The valuations continue to be extremely, extremely expensive, and that's the flip side of it. 2023 being a pre-election year, uh, market could be a little bit cautious, and the valuations on the other hand are extremely rich, where you need to be very careful before you invest. So then, having said that, that India is a long-term growth story and the valuations continue to be extremely aggressive, what are the sectors where we want to go ahead and invest? Let's do a sectoral uh, review, sector by sector, and then we see what is our outlook. So let's come on the biggest sector, the financial sector. Extremely positive on the financial sector. We have seen the domestic loan growth to be at about 18% uh, over the last 1 or 2 months, and banks that have started to report numbers are also reporting very strong numbers, right? Uh, uh, the banks are reporting very strong numbers, and the credit growth across all banks, be it large or small, continues to be upward of 18 to 20%. So really, 2023, in my opinion, will be the year of financials, where financials continue to make a comeback. That's the first point. The deposit growth, which was lacking the credit growth, will also start to come back. We have already seen small banks like Federal Bank report a deposit growth about 14-15%. And as a consequence of this, a lot of money which had flown from deposits into equities will start to come back into deposits again, as we see that deposit rates continue to get hiked. So that's the third point that is there, that uh, a lot of money that was chasing equities will start to flow back into deposits also. However, very positive on financials as the loan growth continues to be 20% and the systemic NPAs are at all time low. You will find that financials do extremely well. 2023 could be the year of financial. That is my opinion. I am very positive on the sector. Valuations continue to remain not so cheap. However, the growth should compensate the little bit higher valuations across this sector. That's the outlook on the lending sector. Then, if we come on the life insurance sector, on the life insurance sector, it is a sunrise sector. People are realizing the need for life insurance, and we have seen a lot of correction in some of the top stocks in that sector. So, I'm again positive on that sector as well. Then let's come on to the AMC sector, the asset management companies. Most of them have corrected over the last 1.5, 2 years, even though the asset AUM is increasing on the basis of the compression in the expense ratio that is there. The expense ratio will continue to come down. However, the scale of these companies will continue to rise, and the scale will give rise to the increase in earnings. So, in my opinion, the AMC companies should also do relatively better. The valuations have also corrected across all AMCs, and they look to be a very good bet over a longer period of time. That's on the AMC sector. Generally positive across lenders, asset management, and insurance companies. You have to take your own bet sectorally which companies do you pick. However, in my opinion, 2023 will be the year of financials where large private sector banks will continue to do well, and that will translate into stock price returns. That is my opinion about 2023. Then let's change over to the next sector, which is there, which is the FMCG sector. Again, the FMCG sector has been battered by high inflation. High inflation has meant that input cost prices have gone up sharply for this sector, and many companies have been forced to pass on this cost inflation, which has meant slowdown in volumes over 2022. You will find that this phenomenon exactly reverses out. Inflation will continue to cool off well into 2023. And once inflation cools off, a lot of companies will start to take price cuts so that volumes continue to pick up. Rural demand was another problem for all of these companies, and you will see rural demand also start to come back for a lot of these companies. So you will find that FMCG companies, the demand will slowly start to pick up. Point number one. Margin pressures which were seen for most of the FMCG companies will continue to ease out, and slow and steady volume pickup will happen across all of these companies. However, valuations across the entire FMCG sector continue to be extremely challenging and extremely expensive. And therefore, you need to be very, very careful when you pick out all these FMCG companies. A broad theme across 2023 would be uh, overvalued stocks will continue to have severe challenges as valuation continues to get challenged as the interest rates move to 4%. So, across the FMCG sector, you should think about uh, only buying on corrections. However, on very extremely expensive stocks, you should be very, very careful. Uh, I am very neutral on the FMCG sector because the valuations continue to remain expensive and volume growth will take time to come back. So very neutral on the FMCG sector. However, it is continues to be a defensive sector where fund managers hide because they want to play on the domestic consumption story. So very neutral on this sector. Not too many stocks that we want to include in the portfolio. Then let's go on to the third sector that is there, the pharma sector. The sector that has taken a lot of beating in 2022 because of various challenges across the pharma sector, be it generics, be it complex generics, be it APIs, be it now CRAM CDMO companies as well. All of them have taken a massive correction in 2022. And that's the only place, in my opinion, where real value lies and where good value investors should start to look at some good companies because a lot of pharma companies are facing demand issues because of Chinese slowdown, and they will face further demand issues as China slows down again, and then US slows down even more, uh, and into a recession, and Europe also continues to slow down. So what will really happen is demand pressure will continue to last for all of these pharma companies in 2023 as well, and this will give rise to pricing pressure. All generic companies which operate in the US will face a lot of pricing pressure. Uh, all generic companies. So therefore, they will have a tough time maintaining their margins, and therefore you need to be careful. API companies could see their demand starting to come back. However, that could take around 2 to 4 quarters more. So that's a real challenge, and we've seen stocks go down by 50, 60, 70%, which is a real problem. But a sector, it is among the worst performing sectors of 2022. Uh, and now valuations are starting to get really very attractive, and you need to start looking at these companies, be it in the API sector or the CRAM CDMO sector or the diagnostic sector. You need to start looking at these companies as valuations continue to keep correcting for XYZ number of reasons. Like I said, on the API side, the Chinese lockdown and the European lockdown is a problem, or on the generic side, the US pricing pressure is a big problem, or the CRAM CDMO side has also seen a slowdown in demand because of multiple reasons. So, one place where my outlook is positive, however, 2023 will not be very easy. But then value investing is like buying a Christmas card on the 26th of December for the next year. So one place where you need to be extremely vigilant and extremely studying about all of these companies is the pharma sector, where I am very positive on. Then let's go on to the IT sector. Again, IT sector. In the IT sector, the slowdown has not materialized in any of the results. Uh, the slowdown will start to materialize from this quarter onwards. The expected growth that these companies were seeing will not materialize now, and they will have to cut down on their guidance because the growth is slowing down in all of these companies. Hirings will continue to slow down and attrition will no longer be a problem. You will find that these companies are able to maintain their margins because the attrition is no longer a problem. So therefore, IT companies, we have a slightly negative view because of the fact that valuations continue to remain extremely challenging even after 30, 40, 50% correction. Uh, the short term outlook on this sector continues to be extremely cautious. However, long term we are very positive on all of these companies. Not a problem as such. Valuations need to correct a little bit further for us to have a good exposure in this sector. However, slowdown will be challenging for all of these companies, and 2023 could be challenging business wise for all of these companies as major markets like North America and Europe continue to face a lot of slowdown. So, cautious on the IT sector, but looking for a correction to buy into good quality companies. So, that's the next part of it. Then let's move on to the infrastructure sector. On the infrastructure sector, very positive as as the government continues to pump money across railways and other infra projects like the roadways and building metros and all that stuff. As the government continues to build that, and it will give a huge thrust onto all of these sectors, as this is a pre-election year. And as this is a pre-election year, the government will try to spend a lot more onto all of these sectors. So, infrastructure sector has not performed since a long period of time, and the underinvestments into all of these sectors will mean that government will continue to keep pushing all of these sectors, and uh, good quality companies in this sector will continue to do well. Infrastructure is a very difficult sector to make money in. We Most companies have not made money since 2008. However, what you have to really do is that you have to pick out good quality companies and try to sit on them for long period of time. You will make money on the infrastructure sector. So, infrastructure sector is one sector where I am bullish on selectively. You will have to pick and choose companies from here out, and they will continue to do well. Then let's come on to the metals. On the metal side of it, I'm not very positive as the demand continues to cool off. The inflated metal prices will uh, correct from here on as well, and you will find a lot of valuation froth will also come down from the metal companies as well. So that's one part of it, and as Chinese demand comes back at certain point in time this year, China will also start to dump back the material which it had stopped because of COVID reasons. And again, there will be a huge amount of problem for these metal companies. So metals are generally cyclical in nature, and in the middle of the cycle, you don't need to touch the metals part of it. So that's one sector where from where you have to completely stay away in 2023, unless and until uh, these companies start to make loss again. That's the real time to buy this sector, right? So that's on the metal side of it. Then let's come on to the real estate sector. We have seen that the real estate sector has seen a massive boom in 2021 and 2022, which was mainly sparked off by low interest rates. Interest rates have been really very low, and that has helped pushing the real estate sector. The real estate sector will experience a slowdown as compared to the demand in 2021 and 2022 as interest rates continue to move up. In fact, internationally, we have seen a massive slowdown in the housing demand. However, in India, housing finance developers continue to report very good numbers, and this should continue. On the real estate side of it, we are coming out of a slowdown, and that slowdown has lasted about 4 years because of multiple reasons, which include IL&FS, Yes Bank crisis, DHFL crisis, where uh, where real estate developers did not find funding, which led to a ultimate slowdown of the real estate sector. So on the real estate side of it, extremely positive. Demand will moderate down. However, still the demand will be good, better than what it was during the pre-COVID times when the entire real estate sector faced a rout. So positive on the real estate sector side of it. Per se developers, you need to buy good quality developers. You need to look at ancillaries as well. The ancillaries include tile makers or the paint makers or people like that who supply to them as well. So that's one part of it. Again, linked to the real estate sector and the infrastructure sector is the cement sector, where on the cement sector, uh, I am very positive personally because the infrastructure sector and the real estate sector are just starting off their upcycle, and within that upcycle, you will see that the cement sector will continue to do well. So positive on smaller cement players, and of course bigger cement players as well, who will continue to do extremely well even in 2023. Then let's come on to the new sector which has gained traction, defense sector. On the defense sector, the demand will continue to be extremely strong even in the next year. In fact, the demand is everlasting in the defense sector, because India faces multiple threats across its border from from its two neighbors, and you will find that the demand is extremely strong even in the next year. However, the valuations continue to be very expensive. Therefore, you need to be very, very careful across all of these sectors. So, generally speaking, I have pointed out that the economy facing sectors will continue to do really well. The foreign facing sectors, which is a little bit of pharma, a little bit of IT, a little bit of metals, they will all continue to face challenges as the world starts to continue to slow down. So that's where your theme for investments in 2023 should be. It's a pre-election year. Be very careful. The government will try to dole out maximum spending on infrastructure where it can create a maximum demand and employment, so that it can gain maximum votes. Generally, it has been seen that during a pre-election year, the returns from the stock market are generally negative, though it is not a surety. However, this has been seen in the last 4 5 elections. So therefore, you need to be very careful, be very selective with the stocks that you buy, because as the interest rates have moved up to about 4.5%, only high quality companies which make profits, which have the ability to turn around their cash books, will find favor with the investors. Companies which don't have a good business model, companies which don't go to the path of profitability, will find a lot of problems and will see continuous derating of their valuation. So that's it. Uh, with that, I've taken 25 minutes. Now, let's start off the question and answer session. Anybody who wants to ask a question can request themselves as a speaker, and I will mute them, and then they can go ahead and ask their question.
Aditya sir, can you hear me?
Yes, I can hear you. Please go ahead.
Sir, I want to know the prospects of platform stocks.
Some of the platform stocks are really have really good businesses, right? For example, an IEX has a really good business, or a CDSL has a really good business, right? But valuations across these stocks, even after the correction that they have seen, are not really cheap. They are still expensive. So from that point of view, you must keep in mind that, however, some of the businesses for the long term, they're really very good.
Thank you, sir. Another question regarding animal APIs. Um, uh, what do you can offer me guidance regarding this animal API?
Yeah, the company that does a lot of work in that field, I don't really understand their business model, so will not be able to comment on that.
Okay, sir. Still, can I ask stock specific question also, if you don't mind?
यार पूछ सकते हो, but I will not be able to answer very specifically. बताइए, पूछिए.
क्लीन साइंस के बारे में आपका व्यू लेना था.
Yeah, valuations expensive है वहाँ पे भी. It's a good company, but the valuations are extremely expensive. So you need to be careful.
Okay, thank you.
Hi Prasant,
Hey,
please go ahead. Okay, Karthik, please go ahead.
Aditya, thanks for the call. And
Yeah.
I'd like to know how the interest rate will influence the equity market, and some of the leveraged companies may go through painful, or did we see the peak of interest rate? What is your view here?
So we are picking out on the interest rate cycle, about 25 to 50 basis points of interest rate hikes could be remaining. I believe that the inflation will start to get under control if it is not already, and we are seeing the peak of interest rate cycle. But have we seen the peak of problems with leveraged companies? Absolutely not. Leveraged companies will start to see problems as their interest rate, the rate of interest at which they borrow, continues to rise. Companies which are debt free will have the maximum advantage, as they don't need to really borrow or pay interest on the loans. So, in my opinion, leverage companies will start to face problems and are already facing problems as interest rates in the US go from about 0% to 4%. That is a real problem, in my opinion, for leverage companies. On the equity markets as such, equity valuations are inversely proportional to interest rates. As interest rates continue to move up, equity valuations should start to come down in theory.
Okay, do you see the flight of FIIs? further from our market because of 4% interest rate in US is going to be a comfortable returns for them than invested in India,
So you
which
have
is
already
having currency
seen,
issue.
yeah, all through 2022, FIIs were withdrawing money from India, and still Indian markets did not correct. They corrected with about 10%. And if you go back to 2008, a lot of money was also withdrawn from the Indian markets, and the markets fell about 50 to 60%. So Indian markets have been very resilient because of the domestic institutional flow that is coming in via the SIP money. I don't see a problem as such, and in fact, I see that the FII flow will start to come back to India as the FII money will find no other place in the world is growing as much as India is growing.
Thank you.
Okay, hi Prasant, go ahead.
Aditya, Happy New Year to you and all the
Happy New Year.
listeners. So, yeah, so nice insight as usual, always. I
Mhm.
love to kind of spend hearing your kind of insights in the evenings. So, Mike,
Thank you.
my question is like, say, the high energy prices slash inflation, right? So, how do you see like so both goes hand in hand, right? So how do you see like if you discount or exclude this Russia-Ukraine war, right? So how
Mm.
do you see the energy prices, say Brent slash natural gas, which is one of the we Indians like we import one of the biggest number, right? That's our highest weightage. So how do you
Mm.
see that? Because that one of the key factor determines our growth outlook for India.
See, during this year and in Europe as well, Brent is not a problem. Oil is not a problem. Oil has been in the region of 80 to $120 since the past one and a half 2 years. That's not a problem. The real problem for Europe and for the rest of the world, including India, is the natural gas prices, which has shot up nearly about four to five x over the last one and a half year, because Russia has attacked Ukraine, and it is using gas as a means to you can say blackmail, or you can say trying to negotiate the prices of gas so that it can fund its war. So that's the real problem that is out there. Gas prices have now corrected by 55% from the top as the demand continues to cool off, and European reservoirs are full of gas right now, but those reservoirs will start to get used up as the European season moves on. So natural gas prices are extremely hard to predict. It's very difficult to predict them. The prices have corrected for now, but you never know if Russia closes down the Nord pipeline to Europe, you will find that the gas prices start to shoot up again. So that's the main problem. Brent is not the main problem. Brent, we know that will start to it will trade here in the region of 80 to $120. Gas prices main problem. I don't know. I follow natural gas very closely. Still can't make out what will happen to the natural gas prices. Of course, this correction was warranted, but still can't make out. It will depend on how Russia behaves.
I see your point on the natural gas. Like Norway is supplying, right? So as one of the biggest suppliers
Yeah,
now, like to substitute
right.
Russia. So they're
Russia,
making
correct.
billions of kroner. I can see that pretty live. Yes. So yeah.
Correct.
Thanks for your insight. Like it's good to know your kind of a view on the natural gas. You give more weightage to that. Yeah. Thank you. Yeah.
Okay. Karthik, go ahead. Okay. Karthik is not available.
No, no, Aditya, I can.
Yeah. Please go ahead.
I thought I already asked. Okay, I have still one more question. What is
Okay.
your view on these latest uh, new generation companies, and it is going through taking away a lot of wealth from retail investors? Still, new gen companies are still coming in IPO and tapping the
Mhm.
money.
See,
Most of them are they are offloading. The promoters are offloading, and it's like a dump. So, would you see that? Uh, any IPO failure can happen, and how you view this scenario?
it is very clear. We have said multiple times across my social media platforms that companies are using the IPOs to dump their shares. Nobody has asked retail investors to go ahead and invest in those companies. Retail investors do that because they want to make a quick gain out of investing in those companies, which has got the IPO pop. Generally, it is not advisable to invest in IPOs. If it is advisable to invest only if it's a very high quality company. That's the first point. The second point is the valuations were crazy for all of these companies, and now we hear Mama Earth is also coming at a very crazy valuations. See, it is the promoters will try to sell their shares at the maximum price possible. It is up to you to see if you want to ignore or not. That's how the stock markets really work. And if a lot of people do not buy the stock, the IPO would fail out. So promoters are crazy, investment bankers are crazy. They are very, uh, they're pricing the IPOs very expensively for companies that don't make profits. The simple thing that you can really do is avoid those IPOs, let them go. And we have already seen what has happened in the case of Paytm, or we've seen what has happened in the case of Nika, where after the euphoria, the stock has settled down and come back. So uh, buy a company not because you want a listing gain, buy a company because you think the business model is really good.
Yeah, thank you.
Right? Okay. Uh, who's next?
Hello, sir. Good
Nuba.
evening.
Yeah, go ahead.
Happy New Year.
Happy
So,
New Year.
a few months ago, sir, RBI intervened some of the mutual funds which were investing in the foreign markets. But recently, RBI have lifted that cap. So, there is an opportunity to explore the international markets currently. So, what is your view? We should diversify our portfolio into such markets for fresh
Yes.
investments.
Definitely. So, in my opinion, 10% of your portfolio should be aligned towards the US stocks because US stocks are the innovator stocks. That's where you should be really investing 10%. Many funds are open, many funds are closed. You need to find out which funds are open and which funds are closed so that you can go ahead and invest in those companies, in those mutual funds. However, exposure to the US is a given. You must have some exposure to the US.
And so, what is your view on gold or silver? Because lots of central banks are heavily buying gold as a reserve. So, what is your view on gold or silver, something like that?
Yeah, it all depends on how what geopolitical tensions play out in 2023. Central banks का काम ही वो है कि वो gold buy करते हैं, उनका वो reserve होता है. So they will continue to buy them. However, my view on gold is positive. Gold should scale new highs in 2023. However, it is a small part of my portfolio, not a very big part of my portfolio.
So, few companies are there which are known as ESDM, Electronic System Designing and Manufacturing.
Mm,
Few companies are listed in India like Dixon, and two,
mm,
three new players are emerging out. So, what is your
mm,
view on this segment? Because India is iPhone, Foxconn, they are starting up
mm,
their hub in India.
mm,
So, these all companies may also get some
mm.
uh, uh, orders from these large companies. So, what is your view on this sector?
Could be possible that they get orders. However, the valuations of these companies like Dixon is extremely insane. So you need to be careful there.
Okay, sir. Thank you, sir.
Yeah,
Happy New
thanks.
Year.
Okay, Sarthak, go ahead. Sarthak or Debjani, go ahead.
Hello, sir. Good evening. This is Debjani this side. So, I had a question regarding your opinion in the renewable energy sector and the stocks in it, like Electra or even Tata Power, which
Mhm.
have corrected. And like, what's your overall view about the renewable energy sector with like government pushing this and ESG coming into play and other things, money being put in? So, what's your view regarding that sector?
Positive on the renewable energy side of it. Rather than Tata Power, a lot other players are also available. Positive on it. Specifically on Tata Power, the valuations are expensive. You need to be careful on that.
Okay.
Positive on that. Uh, on the EV side of it, not sure who will win the EV race. EV is a very
Yeah,
nascent
and
technology.
Tata Elxsi being corrected to such a good extent. What's your take on that? Maybe.
Ma'am, Tata Elxsi is still very expensive. If you look at the
Yeah.
valuations, You will
Definitely.
find it very expensive. I had put out this tweet in 2020, where the
Yeah.
stock had corrected from about 1400 to about 700. Nobody was wanting to buy it. Now
Yeah.
everybody, the P multiple at that point in time was 20. Today it still trades at about 60 times multiple,
Yeah.
which is extremely expensive. So it is still expensive, as I said in my opening remarks, that the IT
Yeah.
sector is still expensive. You need to be very careful when you go into the IT sector. The slowdown has not materialized. 2023 will
Okay.
also be a pain year for the IT sector.
Okay. Okay. Got it. Thank you so much.
Yeah. Darpan, Sunny, any of you can go ahead.
Yeah, hi, Darpan, yeah. Thanks for the opportunity and thanks for the brief on this. My question is basically on one of the sectors that you spoke about, defense, where
Yeah.
you said you're positive
Hey,
given the long-term order books that
Hmm.
the companies are having.
Hmm.
The question that I have is, you have front lines like BEL, HAL, which have
Hmm.
run up. You have
Hmm.
other companies, the smaller companies like MTAR, Paras, Data and
Hmm.
Solar, which are expensive,
Hmm.
long working capital cycles or 10 times
Hmm.
sales or whatever, in
Hmm.
terms of when you try to look at them.
Hmm.
And the others you have in the, in the shipyard, Cochin shipyard or Mazagon and all that, where operating margins
Hmm.
are, they've also run up. All of these have run up.
Hmm.
So when you
Yeah.
actually try to kind of shortlist something for your portfolio, the choice is extremely difficult. So your views on that, please.
Definitely. The problem with the defense sector is that the major contractor, which is the government, does not have money. And generally, we've seen what really then happens. What happens is HAL needing to take loans to pay off salaries, which is a major problem. Uh, all stocks have run up because there has been a de-rating in the defense sector. However, challenges remain for the defense sector that the major contractor has a major problem. Valuations are expensive. You need to be very careful before you buy them. I was very clear in the opening remarks also that the long term potential needs to be, it seems to be good, where the demand is strong. However, the valuations are extremely challenging for all of these companies.
Would it be preferable to stay with the frontline ones like BL, HL as compared to the private sector ones, which are comparatively very small players, if you look at it in terms of their
Uh, it depends on
longevity or the working
Yeah,
capital
it
cycles?
depends on the product that the companies have got. For example, Cochin Shipyard has got is building the aircraft carrier for Indian Navy, or Mazgaon Dock has its own specialization. It really depends. Or an HAL which builds the Sukhoi planes for the Indian Air Force. It really depends on what kind of a product that these companies have.
Aditya sir,
And please go on.
Sarthak here.
Yes, please go ahead.
I want to know the prospects of home finance companies.
Housing, as I said to you, housing finance companies will continue to do extremely well. We've seen today HDFC's home loan sales to HDFC Bank grow at 19%. So you will find that housing finance companies continue to do extremely well, as housing demand is relatively better than the pre-COVID times.
Okay, thank you.
Hi, hey, Anurag, how are you?
hey, Aditya, hi. So, first of all, I think to all
Hi.
who are listening to us and to you, very happy and prosperous new year, Aditya.
Yeah,
So, Aditya,
thank
a
you.
quick take, and I
Thank
think
you.
I'm hearing all
Yeah.
interesting questions from coming up from
Mhm.
people which are
Mhm.
very stock specific. But
Right. Mm.
I think overall, what is your take at an index level?
Mm. Mm.
I understand there might be opportunities in stocks, but at an index level,
Mm. Mm.
from these
Mm.
levels,
Mm.
where do you see 2023? We barely got a 3% return. Okay, we were not
Mm.
negative for
Mm. Mm.
2022,
Mm.
whereas the world
Mm.
was
Mm.
negative. But
Mm.
2023, how do you see index moving end of the year? Not a prediction, but some broad sense.
Yeah.
Yeah.
Yeah, Warren Buffett says there's that in the short term, only two people know what happens. One is the God and another is the liar.
Hmm.
But here are some facts. Here are some facts. The structural story of India continues to gain momentum as each year goes on.
Hmm.
The government is taking a lot of backroom changes in order to get manufacturing into this country. We will see, not this is not a 1 year story, but however 5, 7, 10 year story. That's what every fund manager is looking at and saying that India seems to be very lucrative.
Hmm.
On the flip side of it, you find Because of this phenomenon, where India is supposed to start manufacturing over the period of next 5, 7, 10 years, valuations continue to be extremely challenging from here on as well. Even though the index is not given has given 2 to 3% return, the valuations are already above the median valuations, and I will not be surprised if he undergoes some bit of time correction from here on as well.
Hmm.
But on the flip side of it as well, remains overvalued will continue to remain overvalued because of the fact that the structural story is pulling growth and is pulling expectations. So here is an interesting fact. I just met a fund manager who manages huge amounts of AUM. He works with the top AMC in this country. He had the same view that. Uh, he feels that the markets are very overvalued at this stage, but he's been a fund manager since 90s, and he finds is that never in his lifetime was India such a strong story. India will
Hmm.
continue to remain a strong story, and therefore that could be the reason why the valuations could continue to remain extremely much.
Hmm. Okay, sure. Yeah, I think that's fair. So at an index level, we might see a plateau, but we will have to continue to find opportunities below the index, right? That's what it
Yeah,
means. Yeah.
there's multiple opportunities available.
Hmm.
As I said, across many sectors, multiple opportunities are really
Hmm. Hmm.
available. You just need to watch out. As you've seen, the pharma sector has taken a lot of beating. Valuations there continue
Right.
to start to look very attractive,
Okay, sure.
right?
Okay,
But it's a long
happy
term
to
play.
step aside, and thanks for your thoughts. And others can ask
Thanks.
questions. Thank you.
Yeah, thanks. Okay, Divya, you've been waiting for long. Yeah, you can go ahead and ask your question, please. Hi, Divya, you can ask your question. Okay, she's not there. Then let's go to Hemant. Hemant or Sunny?
Yeah, hi Aditya, good evening.
Hi, good evening.
So I want to know your take on alternative investment funds like IR Invits and Power Grid Invits.
Okay, so InvITs are a good opportunity for anyone who is looking for a higher dividend yield. However, InvITs come with their own set of challenges, where taxation is not really very smooth on these structures, and they will take some time to develop. So, in my view, they can be a small part of your portfolio, however, not a very big part of your portfolio.
Okay, thank you.
Sarthak, you can ask your question. Soumya, Jayesh,
Hi Aditya, this is Soumya here.
yeah, please go ahead, Soumya.
Can I ask the sector specific? Is it okay for you to answer?
Yes, please go ahead.
Actually, I want to know about the textile industry.
Hmm.
Uh,
Okay. Uh, on the
in
tech.
that, there are three segments, right? Like
Mm-hmm.
mills, fabric, and apparel. So, which is a in which segment we can invest?
See, on the textile industry, I am very cautious. I have always been very cautious because the government promises a lot and has failed to deliver a lot of times. And I find that Vietnam and Bangladesh are much more competitive in the textile space rather than India, and that's where from where the demand is going to. The first point. The second point is, as demand across the world and in India also slows down, I will want to be very careful on the textile industry.
Okay, thank you.
Thank you. Yogesh, Rajendra,
Hi, sir.
hi.
Sir, I want to know about pharma sector and particular stocks.
Mm.
Your view on Shipla.
Okay. Cipla is doing extremely well. Their US portfolio, which is going to come up in 2023, is going to do extremely well. They are doing well. On the Indian side of their business also, they are doing extremely well. So that's one stock which is done extremely well. However, as 2023 goes on, the pricing pressure has really intensified in the US. Uh, there could be a problem, but their innovation across many drugs means that they will do extremely well. However, now the Cipla stock is extremely expensive. The pharma index is making a lifetime low, whereas Cipla is making a lifetime high. So it's been one of the best performing stocks of 2022. Now you need to be very careful.
Okay, sir. Thank you.
Mhm.
Hello, this is Rajendra. Hi.
Hanji, bata. Hi.
Uh, And looking about the outlook regarding 2023, as
Mm,
the people are saying that it would be not a very promising year as per the
mm,
return. How
mm.
do you see whether to invest through SIP or through lump sum? I just wanted to specify, specify whether to go through SIP or not, being a lull year, if you think
So
so.
nobody, so sir, nobody knows if it will be a lull year or if it will be a good year. Most of the times, the predictions turn out to be not so correct. What you can really do is you should always enter the markets through an SIP route. SIP routes helps you get an average price over a period of next 6 to 12 months, and that helps you escape any tops in the near term from your investments. So SIP route is a very good route to invest from.
And what are the sectors do you suggest?
So you can go ahead, and if you don't have expertise in direct stocks, you can just go ahead and invest in a diversified mutual fund, and they will take care of all your investments. The sectors I have already said. Financials is
But
one sector. Financials is
but
one
I'm
sector.
sorry,
Thank you.
but I'm afraid, as being the reports are there, that 70 to 80% underperformance of the large caps mutual funds,
So I'm not
and
asking you
just
to, sir. Agreed. You can go ahead and invest in index funds. Index funds will give you market returns, and there's no chance of underperformance. You can invest in a diversified flexi cap fund, which can invest across all categories.
So,
okay.
so
And otherwise, specifically about the direct investing in stocks, which sectors do you suggest?
As I have already said, domestic facing stocks like the financial, the infrastructure sector, the real estate sector, the pharma sector, if you are a value investor and can wait for about 2 to 3 years, you can go ahead and invest. But let me make it very clear, if you have the ability to track these stocks, only then go ahead and invest in these stocks. If you don't have the ability, then best leave it to a fund manager who will invest on your behalf through a mutual fund or advisor or whatever it is.
Absolutely fine. Yeah, you're right. Thank you so much.
Thank thank you. Yeah, Anurag, you had something to add?
no, yeah, I think on Jayesh's question, the interesting point, one is that of course nobody is saying what is the time frame there when they're
Mm,
saying okay, good sector to invest or not. I think what the time frame is most important,
mm,
and to SIP or not to SIP, I think this may be relevant to everyone. देखिए on no doubt markets are very expensive, and for those who have started investing in after 2020, you might be thinking great story, India story, and all of this. I've lived through 2000 and 2002, and probably I would say compared to this, even that was the best time to be there. Um, and I kind of partly covered this in my story in the Economic Times as well, right? But the stories keep coming, but markets, no doubt, are expensive. And India, there are very few investable companies. कुल मिला के 20-25 कंपनीज में इन्वेस्टेबल यूनिवर्स ब्रॉडली खत्म हो जाता है. So the same companies get most of the funds, and they keep getting more expensive. So SIP is good, and stay on SIP. Do not invest lump sum at this time. And the second is be happy if the market falls, because then your SIP buys more. And I think that's what most of the people are not ready with. They want to start today or add more, but they don't want to see the market fall. मार्केट गिरे तो अच्छी बात है, because एंड prolonged period में your money will buy more units if the market falls. This is very expensive price to enter. So that's at a broader market level. Everybody should keep in mind that okay, 3 से 5 साल का तो time frame रखना ही है, but उसके बाद में भी your money should buy more of the stock. That can only happen if the market corrects a little bit, because ultimately हम सबका पैसा ही market को expensive बनाता है, right? और individual stock और sector तो ये तो बहुत don't place more than 20-30% of your portfolio which you are individually trying to track. There's one more story I want to add here. While you get into all these sectors, and I know we all want to find the next HDFC Bank. HDFC Bank is still not bad, right? So do not try and find the hidden gems. because 90% of the wealth is, as I said, in India, is being still created by these larger companies. And market में एक तो प्राइस बढ़ता है कंपनी की अर्निंग से, एक बढ़ता है हाउ मच मनी इज चेजिंग दो स्टॉक्स. And because your larger mutual fund money is chasing only the bigger companies, they keep getting expensive. And still they keep getting delivering more results, and they keep getting more organized, through GST regime and all. So this is the larger point I just wanted to add. Hope it'll help everyone who is listening to us. Thanks.
Thank you, brilliant insight. Actually, you are right that India is a story where continues to become larger. Right. Okay. Who wants to ask a question? Anybody wants to ask a question? Please unmute yourself.
Hi, Aditya. Jayesh
Hi.
here. Good evening. Really
Good
great
evening.
session. So, I had just two questions. First one being, do you see earnings degrowth somewhere? Because somewhere, if you see the RBI has increased the rates. Now the interest rates definitely, if one takes a loan today, and if one would have taken a loan, 2 years back, then the rates are different. Now,
Mm.
do you see somewhere margins getting pressurized due to high cost of capital? And second question being, like on what basis, you say that any company is expensive? Because if only P multiple is taken, then I think somewhere on those terms we can sometimes go wrong by taking an example, like IDFC First Bank. Now, if
Mm.
anyone would have seen IDFC First Bank TTMP was around
Mm.
150, but
Mm.
maybe the market was expecting that in the future this company can put better numbers, and which it did, and now the P is around 23, 25, I think. So just these two questions regarding whether do you see earnings degrowth due to
Okay.
margin, due to high growth of capital, and how do you say any company which is expensive, like what are the parameters do you see?
Point number one. Let me take the second question first. First of all, every company is valued differently on a different valuation metric. A valuation metric is just not a PE alone. It's a number of factors like management quality, the quality of earnings, and XYZ number of things. Let's talk about a bank. Now, on the bank side of it, you don't value banks on a PE multiple. You value them on a price to book multiple. That's the first point. The second point is IDFC First Bank was expensive. Now it trades at about two times, continue to remain expensive. On IDFC First Bank, uh, the company has not gone through a cycling of NPA. Uh, of course, V. Vadanathan was in IDFC first, was in Capital first, and there he built a brilliant book. However, running a NBFC and running a bank is a very different story. The market is being very optimistic about it, which is fair enough, given the fact that he's a good leader. However, valuation is not just on the basis of price to book; it is on the quality of loans that they give out. It's about the quality of NPAs, the managing of those NPAs, and XYZ number of things when it comes to valuation. The first point. So there has been a valuation expansion for IDFC First Bank from price to book of one to price to book of two. But the first seasoning of NPAs, which will happen 2 or 3 years down the line, that will really decide what valuations does a bank really get. In my opinion, small private sector banks do not sustain high valuation multiples for longer periods of time. It is very very difficult to be the next HDFC Bank. HDFC Bank is HDFC Bank because they were able to sustain very low NPAs for sustained periods of time, which I don't think any small private sector banks will able to do, given the competitive scenarios here. So valuation is a function of hundreds of metrics, and you need to study all of them. I'm just simply breaking it down to a PE multiple or price to book multiple because I have analyzed those companies and I can understand what those companies really are doing. So that's the first point. The second point is uh, cost of capital is continuing to move higher. However, you will find that we are at a similar level where we were in 2020. The first point, cost of capital is one of the ingredients for a company to sustain. However, other ingredients are also the raw material that these companies really use. And um, as the cost of capital continues to move up, the cost of the raw material continues to move down, which severely eroded margins of a lot of companies. So you will find that margins for a lot of companies start to come back. Uh, A lot of companies, in fact, don't have any relation to cost of capital as they don't borrow and have their own money to sustain. So in my opinion, good companies which are very less levered will not find any problem with the higher cost of capital. In fact, they will benefit as the higher cost of capital brings down the cost of raw materials, and eventually their margins will continue to recover.
Thanks a lot. Thanks a lot. Yeah.
Okay, who's next? Hey, KY, or anybody who wants to ask a question, please unmute yourself.
Hello.
Hi.
Uh, I guess my question is it's very fundamental in the sense we are a little bit confused right now in the sense that it's a globally particularly advanced economy. You see, all central banks are doing a lot to see that these economies, advanced economies, come into recession, and they are bound to come because the elevated level of Fed rate for a longer period of time definitely will bring recession into picture. That's happening globally, in the advanced economy particularly. And when you look inside India, here what is happening? It looks like there is a upbeat in the economy. It's a forthcoming in the sense you have the credit growth at 17%, and then the banking sector at the cusp of new things that may come up uh, because low NPA, credit growth, and even the corporate sectors are deleveraged, and even capex they are bringing in. So you look inside within our boundary, we see that economy is going to grow, and for the next at least medium term, for 3 to 4 years. And when you look outside, it looks like the world is going into recession. Now, when the globe is, when it comes to finance and economics, totally integrated in a sense. Decoupling is the theory being pronounced, but in reality, it doesn't happen. So, what's your view? What do you think? It's which one we should buy? Strength of internal economy,
Okay.
or the disturbances, or the recession that's in foreseeable features in the advanced economy? And then how to play the market, Indian market per se? What's your view on that?
Okay. So you need to have the context really right for this.
Hmm.
So what the Indian economy has gone through from 2018 to about 2021 is a massive slowdown much before COVID came about. There was a crisis called the ILNFS crisis, which completely shattered the Indian economy. This is something that needs to be said before to set the context right. So the Indian economy was much into a slowdown much before any of the COVID problems started to hit. Credit growth was at about 60-year low. No banks were ready to lend to each other, and the economy generally saw a big slowdown. Auto sector numbers were poor, infrastructure sector numbers were poor, and we have seen all of that from 2018 to about 2021, right? On the contrary, if you look at the US markets during that period, that was a period when some mutual funds made humongous amounts of return investing in a lot of blue chip companies there. So, what has really happened is India is coming out of a very big slowdown, which got accentuated by COVID, about 4 to 5 years of a big slowdown for the Indian economy per se. That's point number one. Point number two is the credit growth is now very strong because we are coming out of a very low base, and practically no credit was given out for the last 2 to 2.5, 3 years. The second point. The third point is as interest rates continue to move up from the US Fed, there will be a slowdown in the world economy, and which we are now clearly seeing. That's the third point. The fourth point is the world is very interconnected with each other, and definitely India will also feel the impact of higher rates as the services they export, they will also find a slowdown. But India will be relatively better off. The term that I would use here is relative. It will be relatively better off than the advanced economies, and that's what is playing out in the markets. That the advanced economies are seeing a major correction, and India is holding up because India's prospects over the next 3 to 5 years continue to remain stronger than they were for the previous 3 to 5 years.
No, this is yeah, yeah, fully, it's just totally logical what you said. But only one thing, when it comes to the pricing in the economy part. So if you see the relative performance of the stock market vis-a-vis
Mhm.
the, leading large economy and vis-a-vis India, already that's the pricing. That's what this comes to our mind.
Yes,
While UCS is 30% down, this is a 15% up. So in a sense, that pricing that we are, 3 to 4 years ahead, what we are seeing the growth, that may be
yes, I
part of
agree.
that is already priced in. So
Yes, I
how to
agree
play
with
the
you.
market? Hmm.
Yes, I agree.
Yeah.
I do agree that I have already said in the start of this space that India remains a structural story. However, on the flip side of it, valuations continue to remain extremely challenging across every most of the sectors out there. Where the
Right.
valuations are not aggressive is that the sector is facing near-term headwinds, and nobody wants to go ahead and invest in those sectors because there are near-term headwinds. So the valuations are extremely challenging, and there is absolutely no doubt about it. And I agree with you.
Okay. Thank you. Thank you.
Yeah. Okay. Last 2 minutes. If anybody has a question, can go ahead and ask their question. I will be closing the space in about a minute or so. Okay, guys. Next week, I have a session which is lined up on the credit growth and how to look at banks, in 2023. After all the lender results come out, we will have a session next week on Tuesday, same time. Thanks a lot for joining in. And if you have any questions, you can DM me on my Twitter handle and I will answer them up. Thanks a lot, everyone, for joining in. And thanks, Anurag, also for taking the time out and joining in.
Thank you.
Thank you.